In our final sessions of this chapter, we're going to put together all the knowledge we've seen so far of ratios and apply them to a question, and we're going to really bring those ratios to life. We'll have a look at calculating the ratios and also interpreting them as well. For that, we're going to have a look at an example called Joe Limited. And what we've been given is the financial statements for Joe Limited for 2 years. So can we see then we've been given the statement of comprehensive income for Joe Limited for 2011 and 2010. All of the figures have been expressed in millions. So we can see then that for the statement of comprehensive income, sales down to profit for the year, your net profit, we can see that sales have been higher since 2010, but profitability has actually gone down. We'll need to use profitability ratios to really see why that's happened. What we've also been given is a statement of financial position for both of those years ended. And we can see then that our property, plant and equipment has gone up, and also all of our current assets have gone up with the exception of bank. So we can see that the bank balance has gone down, but inventory and receivables has gone up. We'll have to have a look at that in more detail. In the equity section, we've been given equity shares and retained earnings. We've also got some non-current liabilities, some loan notes that have increased, and then some payables balances that have increased quite dramatically by the looks of things. Let's have a look at the additional information. The following information is relevant. Note 1, Joe Limited declared and paid a dividend of $5 million in 2010 and $2 million in 2011. So the dividend payment has gone down, and we can also say, well, profitability and cash has gone down. Is that right that they're paying a dividend? We'll have to have a look. Note 2, depreciation for 2011 was $25 million and $15 million for 2010. So again, our depreciation charge has gone up quite a lot as well. And note 3, all the sales were made on credit for both years. Fantastic. So all the sales revenue in the SOCI is for sales made on credit and therefore would have a link to receivables. Let's have a look at the requirement. It says calculate the following ratios for 2011 and 2010. Profitability, liquidity, efficiency and financial position. What we're going to do is in this session we're going to have a look at the profitability ratios, and in our next session in a separate video we'll have a look at liquidity, efficiency and financial position. So let's have a go at these. Now the requirement said calculate, but we're also going to interpret those ratios as well. One of the learning outcomes in the study guide specifies that not only must you be able to calculate ratios in the exam, but also interpret them as well. So although it's not in the requirement, we will be interpreting the ratios as well. If you pull up some paper then, we'll start to answer this question. Now, we're going to split our page into 3, okay, and this is for our example. The first column will be the type of ratios that we're going to calculate. And the first thing we're going to do is profitability. Okay, so that will be requirement part A. We're then going to have 2 columns for both years, 2011 and also 2010. Okay, so we're going to have 3 columns overall. So, first thing we're going to do then is look at our profitability ratios. If you look back in our notes, do you remember we had 5 profitability ratios? The profit margins, asset turnover, and return on capital employed. So let's start off then with the gross profit margin. And let's just recap how we calculated that. We take our gross profit for the year and divide it by our sales revenue and times it by 100, and that's going to give us our percentage. So what we're going to do then is pick off the numbers from the financial statements, calculate the gross profit margin for both years. So, profit margins really affect the statement of comprehensive income. And we can see then that gross profits for both years were 60 and 50, and sales revenue was 250 and 150. So we've got the numerator and the denominator, so let's pop them in. So, for 2011 then, 60 over 250 times by 100. Put that through our calculators. That's going to give us 24%. And that's how much revenue drops down into our sales, 24%. And then in 2010, the gross profit was 50. The sales revenue was 150. So you can clearly see that's a third. So we'll make that 33%, just rounding that to the nearest percentage point. So let's have a look at this then. What has happened? Are we happy with these gross profit ratios? Has the performance improved or declined since 2010? Well, we'll see then that actually it's a bad thing that's happened. Profitability has declined. So, profitability declined. Which is a bit odd really, isn't it? Because sales revenue is improved, yet the profit margin has gone down. Okay. Now, why do you think your sales revenue would increase but your margins would decrease? Well, a logical answer to that would be you're selling more of the product, but for a lower selling price, and therefore making a lower profit margin per unit. So, volume may have increased, so I'll just put an arrow for increased, but units sold at a lower price per unit. Therefore, your revenue would increase, but what drops down into gross profit would decrease. You're selling more, but for a lower price per unit. Okay? So your profit margins have gone down as a result. Now, how do we get to gross profit? Is sales less cost of sales? We've thought about sales, but what about cost of sales? Well, can you see then that cost of sales have increased since last year? Now you would expect that. If you're selling more, then usually the variable cost would go up with that. So it still has increased, but it's obviously not in the same proportion as how revenue has increased. So cost of sales has increased. Why would that be? Well, there's lots of different reasons. But I would say maybe there's been more fixed overhead absorbed, and that would cause the cost of sales to increase. So cost of sales increased could be due to more fixed overhead being absorbed. A bit of F2 being thrown in there with overhead absorption rates. And there could be other reasons as well. Higher import duties, higher delivery costs, more inventory write-offs. There's lots of different reasons. Okay? So what we've done there is calculated the ratios and interpret it. The main interpretation is that profitability has gone down. And we've also given possible reasons as to why. Now, our next profitability ratio would be the operating profit margin. We'll pop that in the first column as a little subheading. Now, if you remember, that would be your profit before interest and tax, which I call PBIT, profit before interest and tax, over sales and multiply that by 100 to get the percentage. Let's calculate the ratios first. Operating profit, 30 for 2011 and 25 for 2010. So the profit has actually increased. And we're going to take that over the sales, which we used for the gross profit margin. So, operating profit then was 30 for 2011 over the revenue of 250, times it by 100. That's going to give us a nice round 12%. And for 2010, our operating profit was 25, and take that over 2010's revenue, which was 150, multiply that by 100. So we're going to make that 17% for a rounding, okay, or 16.66%. 17% will do. Comparing this profit margin to last year, do you think profitability has increased or declined? Well, of course, it's declined once more, hasn't it? So, profitability, again, is declined. Should I say has declined? So profitability, again, has declined. Okay, and that's because of the fall in the operating profit margin. Now, we've already identified some reasons why that would be. Lower selling prices, higher costs in cost of sales. We've already talked about that. So what new information do I hope to learn? Well, what lies between is essentially just your admin expenses, which have increased by 5 million. So our operating costs have increased, and we've also been told a little reason why it's been increased. If you have a look at the notes, do you remember we were told in note 2 that the depreciation was higher than it was in 2010? Okay? Now, depreciation is usually an other expense. Could have been in cost of sales, but we haven't been told that specifically. So we can talk about the fact that depreciation has gone up. So, operating costs have increased. This could be due to the higher depreciation charge in 2011. Now ask yourself this, why would you have a greater depreciation charge than last year? Well, there is an obvious change to non-current assets that we can see. If you look at the SFP, at the very top, can you see that property, plant and equipment has increased in value, which would suggest that we've purchased new property, plant and equipment. The only other reason would be a revaluation, but if there was, surely we would see that in the revaluation reserve. And if you look at the question under equity, there is no revaluation reserve. Now, the only two reasons why your tangible assets would increase is if you bought new property or you revalued it. Well, we didn't revalue it. Okay, we must have bought new property. And therefore, that would have led to the greater depreciation charge. We'll write that down. This is due to new PP&E, property, plant and equipment, being purchased during (2011). And we can see that new PP&E has been purchased because the asset value has gone up. Okay? So we've given a logical explanation as to why the profit margin has fallen, and that's because of an increase in our operating costs. Okay, next profitability ratio then would be the net profit after tax margin. Again, I'll make it very clear that 2011 and 2010 will be calculating the ratios for. Remember, you can only interpret financial performance and position if you have something to compare it to. And in this case, we have the 2010 results. Okay? The ratios for 1 year in isolation really don't tell us an awful lot. So, if we take the net profit or profit for the year and divide that by sales, times it by 100, that is going to give us how much of our revenue drops down into the bottom line profit for the year. So, let's have a look back at the question. Let's pick off these numbers from the statement of comprehensive income. So, profit for the year then is 9 for 2011 and 15 for 2010. And of course, the sales revenue is still 250 and 150 for those years respectively. So, net profit then. 9 over 250 for 2011. Times it by 100. And that's going to give us 3.6. We'll make that 4. Just round that to the nearest percentage point. And then for 2010, our net profit was higher. It was at 15. I'm going to take that over 150 and times it by 100 to get our net profit margin for 2010. And that would be 10%. Now that's a sharp fall, isn't it? Your bottom line profit has decreased by 6% as a percentage of sales. So less of my sales revenue is dropping down into net profit that I'm going to add to retained earnings and pay dividends out of. So again, we can see that this has declined. So this margin has declined. Remember, we want these profit percentages to be the higher the better. So if it's gone down, it's a bad thing that's happened. Now, of course, there's many reasons for that. Sales, volume increasing, but the profits that we make from each sale has gone down. Higher cost of sales, higher depreciation charges. We've already said that. What haven't we talked about? Well, everything between operating profit and net profit. And those two lines would be your finance cost and your tax expense. So, look at our finance cost. That's dramatically increased, hasn't it? Okay, dramatically increased. Why would your finance cost increase? Well, it must be because you've taken out more long-term debt. And that's evidenced by the increase in loan notes in the SFP. More debt, more loan notes, therefore more interest. Remember, interest we have to pay. Okay, it increases the risk of the business. So when we get to gearing, one of our final ratios, we'll look at this again. But that has certainly contributed to the decline in the net profit margin. So, this could be because of the sharp increase in finance costs, which could have increased due to the issue of new loan notes in 2011. Okay? So we're given possible reasons why. Okay, so we're analysing and interpreting those ratios. Looking at tax then, there hasn't really been much of a change in tax. That's gone up, which is quite strange really, because your profit's gone down yet your tax has gone up. Now the only real logical reason I can think for this, personally, would be that In 2010, we underestimated our tax charge, because remember, the tax expense is an estimate. And we underestimated it. We paid more in 2011, and as such, we have to add that under provision of income tax to the current year's tax expense. We did that when we looked at limited company accounting, if you remember. So, another possible reason could be the increase in tax charge. So the other possible reason is the tax expense increasing. This could be due to the under provision of 2010 tax charge being expensed in 2011. So can you see then that I'm using everything that I've learnt over the last few weeks in terms of accounting for items that affect profitability and using it in my answer. Now I'm writing it out like this to get you to think about the possible reasons. The exam would never require you to write it out like this, okay? But what they could do is give you a profit margin that's increased or reduced. One of the options could be which one of the following best describes this fall or increase in profitability, A, B, C, or D. So it's really to get you to think about that, and then we'll have a look at some exam-style questions on revision. Okay. So there we have it then. We've talked about the net profit margin and how that has possibly been decreased and what possible reasons we could give for that. Now, to finish off profitability, we're going to have a look at two further profitability ratios. The next one is going to be asset turnover. So, that will be our next heading. Asset turnover. And if you remember, this is where we're going to take our sales revenue and divide that by capital employed. And that's going to give us the number of times our assets generate revenue. Now remember, capital employed is going to be your equity plus your long-term debt. Long-term debt, not your payables. Okay? So how is your business financed in long term? From issuing shares, from issuing loan notes, if we keep this relevant to Joe Limited. So let's have a look back at the financial statements and pick off those figures. Well, again, we know the sales. We've used that plenty of times now. Capital employed, we're going to have a look at the bottom half of the statement of financial position. We can see that equity is 337 and non-current liabilities, long-term debt, is 100. So those two together would give you the capital employed, which would of course be 437. And for 2010, equity was 331 and then 50 in terms of long-term borrowing. So that will give us 381 capital employed that will go as the denominator for asset turnover ratio in 2010. So let's pop these figures in. Sales, 250, over capital employed, 337 plus 100. So we already said that was 437. And that's going to give us 0.57 times. Okay. So for each dollar we spend in asset, it's only going to give us 57 cents in revenue. That's not really good, is it? Okay. You're not really making a return on that capital that you've invested in terms of revenue. If we do it for 2010, 150 over 331 plus 50, which should give us 381. That's going to give us 0.39 times. Now, if you looked at that ratio for 2011 by itself, it looks pretty bad. Okay? Remember, we want something of at least once. Okay? So for each dollar we invest, we generate $1 in revenue. But if you compare it to 2010, actually, the way we utilise our assets to generate revenue has improved. Excellent. So actually it has improved from last year, but it's probably still not at the best level it could be. So, improved since 2010. Now, why would that be? Well, obviously, can we see the numerator at the top is a lot higher. So, of course, the main reason for that is because of higher sales revenue. But it could be better. If we didn't issue those new loan notes, for example, well, what would happen then is that the denominator on the bottom would be lower and the asset turnover would be greatly improved. So it could have been better. But what would we have used those loan notes to pay for? New non-current assets. And new non-current assets may take time before they get into full operating capacity. Maybe you bought that property, plant and equipment 2 days before the year end. And as such, you've increased your capital employed, but it hasn't fully contributed to this year's sales because you may have only bought it 2 days before the year end. So we'd like to think that this asset turnover ratio might improve in the future. So, could be better in the future once new PP&E is used for an entire year to generate revenue. Now we're making an assumption there. Okay, we don't know exactly when they purchased the new PP&E. But, again, it would have been purchased at some point during the year, and therefore it wouldn't have contributed to a full year's worth of revenue just yet. It may get better in the future. We're very positive about this, okay? It is improving. It could improve more next year once that PP&E has had a full year to generate new income for the business and more sales revenue. Okay, now this can be further explained by profitability as a percentage of capital employed. So, our final ratio would be return on capital employed, or ROCE for short. And again, we're going to calculate this for 2 years, so we've got something to compare our current year performance with. And for this ratio then, we're going to take profit before interest and tax, our operating profit, and divide that by our capital employed. But this time it's going to be expressed as a percentage, so we're going to times it by 100. So, we already know the operating profit for 2 years because we used it in the operating profit margin. So, operating profit for 2011 was 30, and in 2010 was 25. We pulled that off the SOCI. Over capital employed, well, we calculated that back in asset turnover. 337 plus 100 and 331 plus 50 And again, we're going to times it by 100 to get a percentage. So we'll make that 7% for 2011 to the nearest percent. And then 25 over 381. 6.56, we're going to make that 7%, get that rounded to the nearest. Profitability in relation to the amount of investment into your business has stayed the same, it's stayed static. So we're no more efficient in generating profit from our investment, our equity and our issue of loan notes than we were last year. So let's write that down. No more efficient in generating profit, but although turnover, remember asset turnover, has increased, this has remained the same and obviously there's going to be a key reason to that. From issuing more loan notes, that has contributed to an increased finance cost. And also, if you remember, we're using that finance to buy new PP&E. Of course, that greater depreciation has also reduced your profit before interest and tax. So really, because we've issued long-term finance, that has had an impact overall on our profitability, and as such, the return we get on the capital that we've employed, so the equity and liabilities we've generated to buy assets, to generate profits, has been no better. Okay. Now, of course, the main reason for that is going to be that we already said our operating profit margin had fell. So one of the key links to this would be because operating profitability fell, not because we're not utilising our assets efficiently. As we said, we were utilising our assets more efficiently in asset turnover, but when we looked at operating profitability, we said that that's gone down largely because of the depreciation charge. Okay? And if you think about it, operating profit margin and asset turnover, if you multiplied those two ratios together, that will give you return on capital employed. So try it at home yourself. If you took the operating profit margin of 12% and multiplied that by 0.57 times, that's going to give you 7% in your calculator. So asset turnover and operating profit margin, if you multiply them together, that is going to give you return on capital employed. And as such, you can explain return on capital employed by breaking it down to how efficient we've utilised the assets to generate revenue and our operating profitability in terms of how much our sales revenue itself drops down into operating profit. So you see there the interlink or the interrelationship with those ratios. Okay, so we'll leave it there for this example. We'll have a look at the other ratios in the next video.